I can now invite Srikanth from marketing to open the batting.
Good evening. Can I humbly ask for a show of hands? How many of you all in this room are from the accounts or finance profession? If you can put your hands up. Slowly they're deciding. Thank you very much. I thought it's going to be a majority. Unfortunately, it was not. Lalit called me when I was in India and asked me to be part of this exciting event. I happily agreed, little realizing that I'm going to be speaking in Sri Lanka, which has got one of the highest per capita population of accountants. When I was walking in, one accountant said, if you throw a stone, from the bush comes an accountant. I didn't know what he meant, but it was a prominent finance guy. Numerically, CIMA Sri Lanka is the largest outside UK, has 2,200 members and 14,000 students. CIMA, CA Sri Lanka, ACCA put together has about 7,500 members and 55,000 students. This is roughly one accountant per 3,000 people. And 3 account students per 1,000 people in Sri Lanka. In contrast, CIM and SLIM put together has only a mere 2,500 students and 2,500 members and 7,000 students. Coincidentally, Sri Lanka also has one of the highest per capita consumption of alcohol and biscuit. Now, I'm not trying to correlate these 3 together by any chance. You might understand why when someone says Sri Lanka has an ABC economy, not an ala batala cost economy, but an alcohol biscuit cost accountant driven economy. Given the above unfair state and an SMS voting impending, we're surely the underdogs for the day. So what I'm going to do is, I'm not going to bring my views, I'm going to bring views which my friends will understand, figures, numbers, quotes from eminent CEOs around the world, so that it's accepted views which will be taken on. First, let's dwell on the topic for the day. In modern era, mark these things, modern era, success and long-term survival of an organization depends on marketing or finance. The topic says it all. It's a cliche topic, debated many times around the world, and an answer has been given, and marketing was clearly known to be the factor when it comes to in the modern era, when it comes to success and long-term survival. But then I've got another 4 minutes or so to go, so I'll have to waste that. Let me start by quoting CEO of McDonald's. He once said, quote, "If every asset we own, every building, every piece of equipment were destroyed in a terrible disaster, we would still be able to borrow all the money to replace it very quickly because of the value of our brand." The same was said slightly differently by John Stewart, who is the CEO of Quaker Oats. He says, quote, "If this business was split up, I would give you the land, bricks, mortar, and I would keep the brands. I would fare better than you." Don't they validate the view long-term survival is through marketing? There's an interesting article by Professor Hunter Hastings, who's a Cambridge University alumni, MD of a leading consultancy company who consults for Pepsi, P&G and Kraft, titled "A New Era in Marketing Accountability." He states in this article, quote, very interesting, "In a majority of organizations, the primary engine of growth in cash flow, shareholder value, is misunderstood and misaligned," what finance claimed it to be the key factor. He says, "The engine of growth is marketing. It's severely misunderstood by corporate power centers, including corporate strategy, financial management, and most importantly, the CFO. Marketing has a singularly important role to play in the 21st century industry. Corporation, sorry. Does this not highlight the importance played by marketing in a modern era?" A survey was done among C-suite employees by Marketing Society, which highlights the following. Chief executive officers place marketing capability at the very pinnacle of corporate processes, the process of driving shareholder value. In the eyes of CEO, nothing is more important. They feel marketing should lead the company and be the key driving force behind the business. These are not my views. It are all said by surveys and eminent CEOs. Isn't this proving marketing has a great role to play in a success of an organization? The same survey, CFO of a fast-moving consumer goods company had this to say: effective marketing is the key driver of future cash and shareholder value. A CFO quotes. A CEO of a financial service company has this to say: marketing leads, operation works out how, and finance assess. That's what he has to say. If you view marketing as a demand generator and finance as a margin driver, an article in the Harvard Business Review in 2005 titled The Relative Value of Growth has this to say: the value of growth from increased demand generation is many times that of increased margin. Late Peter Doyle of University of Warwick validates this. He states, marketing affects growth by building strong brands, brands that deliver superior cash flow, thereby creating superior shareholder value. Let me summarize this session by quoting Martin Glenn, CEO of United Biscuits. He says about failure, the opposite of success. He says, business failures are almost always as a result of poor marketing. All business failures are marketing failures at heart, barring an act of God or plague of locusts. So I suppose all these CEOs would have had some thought, some right thinking. They would have brought all of this up. And I don't think I need better examples than this. Just to bring their views, I'm sure my friends would have understood that marketing is the one which leads for a long-term success and long-term survival and success in a modern era. Thank you very much.
I went to that side because I saw that 98% of the people here are marketing professionals. Good afternoon, good evening, friends. The topic today is who adds more value to the organization for the long-term success. Right? And I believe, my team believes, it's finance. Now, let me start by quickly clarifying a couple of things in terms of the topic. Right? The first is finance. Finance versus accounting. Now, finance is a forward-looking function, right? Basically, the art of managing money. Right? So all of you appreciate the fact that business is about managing money. Accounting is about bookkeeping, slightly backward looking at the past, and it is about recording money in your books. Right? So finance as a function is integral to business success. It's about profitability, it's about liquidity, it's about growth, and it's about stability, which are the hallmarks of a business fundamentally. So what my group would be doing over the next hour or two would be to really talk about how basic financial principles are essential to the success of a business. If you don't follow basic financial principles, your company will fail. Right? That really is what is the credo on which we are going to be talking today. Right? Let me take a few examples. Right? What are these basic financial principles you're talking about? I remember about 8 years ago, when I joined the bank, a couple of months later, I visited a branch with a branch manager to visit a poultry and retail, a poultry farmer who was involved in retail business. And the branch manager informed me beforehand, be very careful what to tell this guy because he's a very arrogant person and he is also someone who has a very high opinion of himself and he doesn't like bankers. But he's such an important customer for us, we would like to lend to them. So I went there and we had a conversation with this guy and I left the meeting very disgruntled. Right? And I realized what he was doing. He was negotiating with the bank to borrow at extremely fine rates. Right? And that is for his working capital purposes. And he was investing his sales proceeds in a finance company. So he borrowed at something like, at that time, 7 years ago, when interest rates for the prime lending rate was about 16-17%, he was trying to borrow from us at 15%, and he was investing his funds in this finance company at 25%. When our deposit rates in the bank would have been about 10 or 11%. Right? So I got out of the meeting and I told the branch manager, do not lend to this guy. 1 year later, the golden key fiasco started. You know the rest. He lost 400 million rupees and he went out of business. So what is the financial principles there? The basic financial principle, understand your risk. Right? You will borrow from someone at lower rates, you will borrow from an institution with low risk and invest in an institution. You will borrow from an institution at maybe high risk, right? A high risk institution, if at all, and invest in an institution with low risk. He did exactly the opposite and he lost his business. Right? True story. Let me give you a second example. A more macro example about the global financial crisis. You know, all of us are suffering the effects of the global financial crisis today. How did it happen? Let me explain in a very simple way. You see, the global financial crisis started with politicians wanting to make home ownership. The politicians wanted to ensure that everyone had the opportunity to achieve the American dream. Everybody should have a home of their own. So they encourage banks to lend to marginal segments of society. People who are unemployed, underemployed, migrant workers, part-time job people. And at the end of the day, all of them were encouraged to take these loans. And as a result of that, the subprime loans industry came to being. Before that, only prime customers were able to borrow for loans. So these subprime customers were afforded these loans, and the discussion was that we will lend to them irrespective of their ability to pay back, because we will be taking collateral from them. And the value of the collateral will go year after year up only, because in the last 3 decades, property prices have all gone up by 10 to 20% year after year. So people took all these loans, and 5 years later, with the World Trade Center bombing, there was a slight reduction in the economic activity, and a lot of people fell into financial difficulty. Again, the principle is manage your risk when you lend. Thank you.
The next speaker is from marketing. Imal, you're on.
Dilshan, thank you very much for that enlightening lecture on lending, and thank you also for not spending too much time defending finance or attacking marketing. Thank you very much. I, on the other hand, am going to focus on 3 operative words. The 3 operative words being long-term success. That's it. I'm going to just focus on that. I'm going to compare and contrast the role of both finance and marketing in this context. See, actually, this is a historic debate. This is actually a conflict between 2 contrasting ideologies. To start with, at this end, it's Peter Drucker's foundational insight on the statement that the only valid purpose of a firm is to create a customer, albeit at a profit. On the other side is the proposition based on the 1973 thinking of Michael Jensen from the University of Rochester, when he published the first article of such in the Journal of Financial Economics, titled The Theory of the Firm, wherein he proposed that the purpose of the firm is to create shareholder wealth. That's it. That's the whole paradigm. That's the conflict. Does the organization exist to create customers at a profit, or does the organization exist to create wealth to shareholders? Now, once the organization goes down that route of continuously focusing on creating wealth to shareholders and continuously beating analyst expectations, that is not the route to sustainable success in the long term. These organizations tend to get focused on one singular point, and that singular point is profit
and profitability. And have you seen how these guys describe profit and profitability? They either use a percentage or they use a ratio. Why did they use percentages and ratios? Because they can use these percentages and ratios to analyze the business, this period versus the last, this company versus the others in the industry, and this company versus others outside the industry. And using all this data, make absolute profound statements about the state of the business of the enterprise, which have had no relevance to the real business. They use all this nonsense just to create profound statements and make it tough for the people who are running the real business. That's the whole issue with this conflict. Look at the tools they use. IRR, throw it at us. IRR, what nonsense is this? Right? What does this do? Right? All it does is get enterprises to focus on smaller and smaller wins. Because if by some chance you go after a grand idea, a grand big idea that takes long time to pay back, what happens? Your IRR is crap, so you can't invest. So then what does the enterprise do? Enterprise focuses its capital on shorter and shorter term wins. Guys, is this sustainable business? Then RONA, remember? RONA, another one they throw at us. Right? Rate of return on net assets. What does that do? Nothing to do with the business. You focus on reducing the denominator. What is the denominator in that? Assets. So because fewer the assets, higher the RONA. Great business. That's the whole thing. But is that how you run a business? Is that how you have a sustainable business of the future? What it does, however, is create scandals. Remember the scandals, the accounting scandal with Enron? That's what created that. Remember the accounting scandal at WorldCom? That's what created that. Tyco International, Global Crossings, Adelphia, MF Holdings, all from that side. Right? So is that what we call sustainably developing and building a future business for the future? Let me give you two real life examples. J&J, remember the scare with Tylenol. What did they do? Warned the consumers, withdrew the product, redid the process, huge cost. But they first and foremost, they took the concern of the consumer, and the concern of the shareholder was looked at absolutely last. And see where J&J is today. Contrast it with BP. What happened in 2010 with the oil spill? Say no, nothing happened, not our fault, somebody else's fault. Hide behind it. It is well documented today that BP's response to the oil spill was driven by short-term concern for BP's profits. And that is what, when you get too boiled down in all this financial nonsense, that's what happens to your business. Let me conclude by saying that I propose that a firm must operate in the real world. It's a world in which factories are built, a world in which products are designed and produced, a world in which products and services are sold and bought, products in which revenues are earned, a world in which expenses are paid, and real rupee profit shows, not ratios and stuff like that. And this is the world that adds value to enterprise. This is the world that adds value to employees. This is the world that adds value to the communities it operates. Ladies and gentlemen, this is the purpose of a firm as prescribed by Porter, not the world of percentages and ratios. Thank you very much.
Chandran, you may respond to that now.
Thank you, Prakash. Success and long-term survival of an organization is more dependent upon finance. What is finance? I think Dilshan roughly touched what is finance. Is all about managing money, allocating assets and liabilities. You have to understand what is finance first and how important it is in an organization to succeed. Operating model of an organization is normally driven by finance. Finance today has a very broad perspective. Finance is enriched with so many activities. And finance has four main pillars, four main principles. You have to stick to these principles and run the business. And if you do so, no business will fail. These main principles are liquidity, profitability, stability, and growth. And also, finance is not only bookkeeping, or finance is not only cost controlling and calculating percentages. It covers a vast range: budgeting and forecasting, corporate finance, performance appraisal, portfolio revisions, corporate finance, treasury, all that. The game of becoming success and to be survive in the long term, finance function has to analyze the environment continuously, scan the environment continuously, and identify what are the changes happening, and adopt if it is required, see for the opportunities and grab the opportunities, finance it, tell marketing what to do. I will bring down some simple, very close examples within Sri Lanka. Take some examples from my own industry, which is finance. The famous Sakwiti case. Who was Sakwiti Ranasinghe? Was an English teacher, a brilliant marketeer, who has promoted his English teaching courses very brilliantly under the theme, under the campaign, Gini Sisila. Gini Sisila is a singular term which is a traditional dance. But what he meant in his case, I teach English in Sinhalese. This is something like flying without wings. Right? So, what happened? He didn't care about the IRR. He didn't care about these percentages. He was successful in his teaching business, wanted to expand, went on diversification. What happened? Didn't calculate anything, went into real estate, went into construction, finally went into unregulated, without license, mobilizing funds from the general public. What happened? Perfectly marketed, priced the fixed deposit at the highest rate in the market, and grabbed all the money from eager depositors. What happened finally? The company collapsed because he was not able to honor his depositors because of the IRR case, because of the percentage problem. He was not bothered. He was only concerned about the cash flow or the short-termism. So what happened finally? 2,000 odd depositors defaulted, amounting to 1 billion. A similar case also touched by Dilshan, the Golden Key credit card company, did the same thing. Priced their fixed deposit at the highest rate, brought all the money in, finally bad financial management, simple internal controls are lacking. They did the investments wrong, all the investments were not done properly. Where is the environmental scanning? Everything was not done sticking to the principles of finance. What happened? 9,000 odd depositors defaulted, 26 billion. Take the other side. I would like to take an example which is closer to my heart, which is the central bank roadmap, the area of consolidation of finance companies. What is happening at the moment? A change has happened. Central bank is telling the companies, the 50 odd finance companies and the leasing companies, you have to become big, you have to become strong. So 58 odd companies has to become 20. What is the role of finance here to play? I think the most important role we have to play is from finance. We have to analyze what are the changes coming up. We have to analyze the portfolios. We have to analyze what are the businesses available for takeover, what are the companies suitable for merge, what are the companies that we are going to take over, and valuing, coordinating things with the central bank. coordinating things with the auditors. If we are not doing it, we are not giving the particular direction, and if you are not doing this, who's going to do this? We have to do this, and if we do it proper, we can be successful in future, and this is the only way we can survive in the long term. So it's proved finance is more important in the long term. Survival and success. Thanks.
Thank you, Chandan. And the final marketing speaker, Taraka.
Good evening, ladies and gentlemen. First of all, let me tell you, as I start my speech, don't get carried away that I'm going to speak for finance, although as of now it seems very heavily outnumbered in the favor of marketing. But I think it's my role to start off with where probably Dilshan and Chandrin finished off. I think their fundamental platform of their whole argument is basically principled on a simple element where they distinguish between financial management and accountancy. So let me take it from there. See, from a financial management perspective, financial guys, the whiz kids of finance, actually use two main tools. One is the balance scorecard and the other one is the IFRS. So let me start with that. See, if I talk about IFRS, let me first talk about, I think the accountants here will know it better, but since there are more marketeers, before IFRS, it was International Accounting Standards, it was IAS. IAS was predominantly, which was basically issued from 1973 up until I think 2000, was predominantly focused on cost-centered and rule-based accounting, right? And then, very significantly, the financial whiz kids moved into IFRS. What does IFRS stand for? Is International Financial Reporting Standards. But more importantly, what you need to understand is IFRS is more inclined towards fair value accounting, which encompasses more of intangibles into the equation. So my simple question is, if you think that financial management is all about the importance of success of organization, why do you want to bring in intangibles which we marketers keep talking about? Brand value, what we talk about, the whole essence of organizational value into the whole equation. In simple terms, they do understand that the role that they play is far superseded by marketing, and you need to bring this in. And if you talk to some of the finance guys in the market, they will tell you they are not far away from actually capturing the goodwill of brands, the value of brands. So where are they heading? So that's why I said, don't take me wrong, I'm not talking on behalf of them. I'm just trying to put a perspective in what, from the start, what our proposition was. You need to understand the topic. Modern era, in this modern era, success and long-term survival of an organization. Now, my two colleagues very articulately told you what the modern era is, and then the long-term survival, how it runs in. And I'm going to tell you, the topic carries the survival of an organization depends on marketing or finance. What we are trying to tell you here is, of course, yes, finance is important. You get the numbers crunched, but the organization's success don't depend on that. There's a big difference between supporting and dependent. If I just take out something, you see, finance guys are more or less referred to as a drunkard using a lamppost. Just using it for just lean on rather than the illumination. So what we are talking about is the illumination. We're not just talking about just leaning on. So you need to understand the context. So I will just take two examples. And in fact, my colleagues were telling me, you need to take one example from Sri Lanka. So I'll take the example from Sampath Bank. Because unfortunately, most of our companies are still dominated by finance guys, so you don't have the marketer's way. But Sampath Bank actually proved them wrong. You see, 4 years ago, when Sampath Cards were rebranded, Sampath Cards was a non-existent entity. But if I tell you, Sampath was the first bank to introduce MasterCard to Sri Lanka, right? But we were number 7. We were, in terms of cards, we were number 7. We were 4th in terms of revenue. Today, with the simple proposition of marketers' brand proposition, we have done so much of wonders. But I need to tell you, when the proposition came from a marketeer, my own corporate management the only thing they didn't do was throttle me. Why? I just put down the charges the bank earns, which ran into almost about 7 million at that time, 4.5 years ago, which is currently probably about 30 million revenue. And I said, I don't want this. We forget this. Drop these charges. And they said, look, you're crazy, right? Today, we are almost number 1. I see my colleague in HSBC here, but almost number 1 in terms of revenue. We are number 2 in the number of cards, with the simple proposition of the responsible choice. The brand proposition of cards. Nothing to do with numbers. If we went by the accountants and didn't drop that and wanted to have the marketing proposition, we wouldn't have achieved what we would have achieved. So that's a simple example to tell you the connotation of how marketing has taken the floor. So unfortunately, my time is running out. So I would leave the best part of breaking the arguments to my second speech, but I will leave this thought. Please keep in mind, whatever we are doing here today is to make sure that the success and the long-term survival of an organization depends on marketing or finance, not just supporting the role that is played by either by marketing or by finance. Thank you very much.
Good evening, friends. Now, as the story goes, a man is getting into his shower just as his wife is finishing up. The wife and the doorbell downstairs rings. The wife quickly wraps herself in a towel and runs downstairs. When she opens the door, there stands the next door neighbor. Before she says a word, Bob, the next door neighbor, says, I'll give you £800 to drop that towel. After thinking for a moment, the lady drops her towel and stands naked in front of Bob. After a few seconds, Bob hands her the £800 and leaves. The woman wraps back herself in the towel and goes back upstairs, where she gets to the bathroom and her husband says, Darling, who was that? It was Bob, the next door neighbor, she replies. Great, the husband says. Did he say anything about the £800 he owes me? So, friends, moral of the story. If you share critical information pertaining to credit and risk with your shareholders in time, you may be in a position to prevent avoidable exposures. So, friends, here lies the importance of financial disclosure. Sustainable reporting. Thank you, my learned friends on the other side, for explaining what GAP was, what IFRS, so I won't take time to dwell on it, but I will have more time to attack. So thank you. Basically, disclosure helps us to implement the basic principles: historical cost, revenue recognition, matching, and full disclosure principles. There is a need in today's environment to instill accountability, not accounting, but accountability among all professionals. So professional transparency is key. And the disclosure is not just to shareholders, as Imal mentioned, but to all stakeholders. So that is the value that we give. We open out. So the importance of exposing risk for early detection and determining true rewards of any company that ensures long-term sustainability. Right. I will then focus very quickly on a second point: cash flow versus profit. I think somebody did mention there the basic fact that marketing should be given a free hand so that they can go out, sell products, build factories, manufacture products, give services out. But we have to assess. We have to put these two on a weighing scale: cash flow versus profitability. And why do we do this? We have to do this to avoid the likelihood of overtrading, which can lead to a cash crunch. I will give you a small example of Reckitt and Coleman, which some of you with grey hair and older in age will remember as being one of the leading companies in Sri Lanka. and of course, currently, Unilever. When Reckitt started marketing, they ran behind a sale. They ran to increase sales, increase revenue. So what did they do? They gave extended credit periods to increase their revenue. But then they were blinded to looking at the profitability, because every time you have an extended credit period, you have to fund it in some way. So there was a situation where interest was very high, and therefore the cost of debt, the cost of funding, almost killed Reckitt's company. Unilever, on the other hand, what did they do? They only gave 1 week of credit to just their prime and their super prime customers. And sales was on a cash basis, avoiding excessive costs. So therefore, there is the emphasis on solid working capital management. Then let me touch upon value creation. Success and long-term survival of organization is pivoted on value creation and sustainable success. I will just touch upon one other area, which is triple bottom line. As my learned marketing colleagues do understand the letter P so very carefully, because they can only relate to the letter P in the English alphabet. Instead of 4 Ps, I will just share with them 3 Ps. And 3 Ps is profit, people, planet. So what is that? I'm talking about triple bottom line. I'm talking about sustainability. I'm talking about economic outcome, which is profit, social ethical impacts, which is fair and reciprocal social structures, employee welfare schemes, charitable contributions, fair trading, and SCR initiatives. And also the third P, which is planet, is basically sustainability of the environment. So therefore, I'm focusing on sustainable reporting, and that's why institutes like the ACCA focus on sustainable reporting. So it is long-term, it's futuristic, it's retaining the resources for our future generations. So finance has evolved now. It doesn't just look at the historical fact and look at financial reporting. So in conclusion, sustainable success can be assured by contributing to sound decision making, enabling organizations to plan, developing and implementing the long-term strategies of any corporate, making tangible assets going forward as they assess the changing environments. We all live in a very flexible, very flux changing environment, so we have to make tangible changes. In short, we ensure that the firm's objective is maintained, which is maximize returns to all stakeholders, particularly not only the shareholders, but employees, suppliers, and all stakeholders, thereby contributes more to the success and long-term survival of any organization. Thank you.